Investments in financial assets. Now, this is a scenario where the acquiring corporation has no control or influence on the underlying securities. So, for example, if Megaco buys 10% of the shares in Blue Corporation, certainly 10% ownership would not mean that these two companies are tied together or one is a subsidiary of the other. So just as an individual would buy some stocks for their portfolio, a corporation can do the same thing. But it certainly doesn't mean that there's a strong influence between those two corporations. So if that is the case, in other words, the company acquiring the shares only has a minority position in those shares, there are three classifications that are allowed. And really what the classification is going to affect is how the return is going to be reported. And we can break down the return into two components. One is income. So for stocks, income would be dividends, and for bonds, of course, that would be coupon payments. And the other part of the other part of return is change in price or capital gain right there. And that's the one that we really have to pay attention to because each of the methods has a different treatment for capital gains. And when we say capital gains, we mean unrealized capital gains. So in other words, the security hasn't been sold yet, but its market price is changing. So the question is, how do we account for that gain or loss? Okay, so let's have a look at our three methods. The first method is referred to as fair value via profit and loss, or FVPL. And in this instance, as the name actually suggests, the change in fair value is recognized as profit or loss, which is in the income statement. Now, one thing we should note is the following. Notice that irrespective of the method, they all treat income as part of profit or loss, or it's recognized in the income statement. And here's the reason. Income is objective. So when a stock just paid a dividend of, $3 a share, there's no question about its objectivity. So all the accountants will allow you to recognize that dividend or coupon income in the income statement. What is at issue is the change in price. And that is a little bit less objective. And that's why you're going to see differences when it comes to accounting for change in price. Now, with fair value via profit and loss, as we're going to see in a bit, these securities are fairly liquid. They're traded short term. So their prices are fairly objective. And that's why any change in price or capital gain or capital loss is pretty objective. And therefore, the company may recognize that in their income statement. Now, the second choice to account for these financial securities is using fair value via OCI, or other comprehensive income, and there's the abbreviation right there. And as we indicated previously, when it comes to income, there's no issues with regards to subjectivity. So if that security pays any income, such as dividends or coupons, it's going to be recognized in the income statement. However, what if that security was bought at 100 and now it's trading at 120? With this classification, that change in price or the capital gain would be recognized in other comprehensive income. So it would not be directly recognized in the income statement. Now, what does it mean when the gain is put in OCI and not the income statement? It means that the fair value, so if you look here, the fair value, because it's still being carried at fair value, it will be reflected in the equity of the firm. So if the fair value goes up and you're reporting it at fair value, you're going to report higher assets and therefore higher equity. So the equity will go up. However, we're just not doing it through the income statement. Instead, it's going to go through this alternative route, which is called OCI. So it won't appear in the income statement, but it will still trickle its way down to equity. Okay. And if I had to elaborate on this, what's the logic there? The logic there would be that, if a security is deemed as fair value OCI, the returns would be either not objective or they're too erratic, and therefore it should not be combined with earnings, because when we see earnings, we kind of like to see sustainable earnings. So again, fair value OCI does affect equity, but we like to sort of bypass the earnings. The last classification is amortized cost, and in this case, the investment is carried at cost. So again, its income is recognized in the income statement or net income. However, because the asset is always carried at cost, there's no capital gain to report. To illustrate, so if you bought an investment at 100 and now in the market it's trading at 120, well, if we're carrying it at cost, then in our balance sheet, we'd still be reporting at 100. So therefore, there wouldn't be any capital gain. Okay. Now, let's look at some of the specific securities that would fall under this classification umbrella. First, we're looking at equity investments. So these are stocks. These would be reported, they have to be reported fair value. The only question is, would the fair value be recognized as profit loss or OCI? And the logic there is stocks don't have a maturity value. So there's no point in carrying it at cost. So therefore, the amortization cost is not permitted for stocks. Now, if the stock is held for short-term trading, then we have to use the fair value P&L only. For all other stock positions, the firm can use either fair value PL or fair value OCI. So again, all stocks must be carried at fair value. But if the stock is being held for short term, then we have to use the P&L version of fair value. However, once a designation is made for a particular stock, you can't reverse that designation. So if you've categorized the stock, so let's say you hold shares of Mega Corporation and you designate it as FEPL when you bought it, then you cannot change it to something else. Okay. And let's look at derivatives. And derivatives that are not used for hedging purposes, in other words, they're speculative positions, you have to use the profit and loss version. So for example, if you think you're bullish on a stock and you buy a call option, certainly that's speculating, and then you'd have to carry that call option using the profit and loss approach. Okay. And the amortized cost approach is only applicable for bonds that are intended to be held till maturity. And therefore, the carry value on the balance sheet will converge to the par as the bond approaches maturity. So bonds that are going to be held to maturity, here's the logic. We know you're going to get par value when the bond matures. So what is the point at reporting fair value while the bond is held? And that's really the logic. So again, if the bond is going to be held to maturity, you're just going to get par. So there's no point in reporting this bond at fair value year over year when we know what the end game is going to be on this bond. Okay. Now, if the objective changes, in other words, the company now intends to sell the bond before maturity, then the bond may be reclassified into a fair value designation, either P&L or OCL. Okay. Now, when this redesignation occurs, so when you say, okay, I'm shifting this bond from amortized to fair value, restatement of prior year's financial statements is not required. So you don't have to go back from the time you bought the bond and then restate your financial statements using one of the fair value approaches. Instead, any accumulated change in price, which is capital gain, as of the date of the restatement, would be recognized as a one-time catch-up, either in the income statement, if you're classifying it as PL, or in OCI, OCI, sorry. For example, if the bond was bought, let's say at $100 5 years ago, and its market value right now is $120, but we were using the amortized cost method, it would still actually be reported at 100 on the balance sheet right now. But let's just say today the company says, you know what, we're going to switch to fair value P&L. Then that $20 in gain that's been accruing over the last 5 years, you would recognize it as a one-time item on the current year's income statement. And then you would, of course, on the balance sheet, you would write up the asset from 100 to 120. On the other hand, if we reclassify the bond from fair value, either P&L or OCI, to amortized cost, then the fair value at the reclassification date will become the new book value for the underlying bond. So let's say it was the other way. You've been reporting this bond at fair value, and you bought it 5 years ago at 100. Now it's trading at 120. So on your balance sheet, it's actually reported right now at 120 because you are using fair value. And then you say, you know what? We change our mind. We're going to hold this bond till maturity, and we want to use it. Therefore, you have to use the amortized cost approach. So then that 120, which is the current market value of the bond, effectively becomes the cost basis for the bond today. And then you would amortize from the 120 today to 100 on the maturity date. And at that point, you no longer care what's happening to the market value for the bond. In other words, with amortized cost, you're just going to write down the bond from its current value of 120 to 100 when it matures. Okay. So for bonds, it seems any of the three classification approaches may work, whereas for stocks, you can only use one of the fair value approaches. Now, for bonds or debt investments, credit losses must be recognized on an expectational basis rather than waiting until the actual loss occurs. And this is really part of the conservatism principle of financial reporting. If we expect bad news, we have to recognize it as soon as possible. Okay. Now, what that means is the company is required to project things like probability of default, loss severity. These are all ingredients needed to calculate credit losses. So, for example, if the bond is trading at 100 today, but we expect a rating downgrade over the next year, and we expect the price to drop 70, then we would actually have to write down the value of that bond today, even though the rating downgrade hasn't happened yet, or the loss hasn't happened yet. But we have to write it down today and take an equivalent measured loss and recognize that on our income statement. And again, this isn't just specific for securities or investments held. This is a much broader conservatism principle. Bad news must be recognized on the financial statements as soon as possible. Now, all financial assets, stocks or bonds, are measured at fair value when initially acquired. So on the day the security is bought, the book value is simply set equal to whatever the fair value of that security was on that date. Now, when evaluating the operating performance for the firm, we really should exclude its investment activities. Therefore, from the balance sheet, we should remove the value of all securities that this firm is holding. So any stocks and bonds that the company is holding for investment purposes should really be removed. And of course, what that'll do is it'll reduce the assets and reduce the equity, because we're effectively removing whatever portfolio that company's holding. And similarly on the income statement, we would remove any income or capital gains that's recognized on the underlying securities. So what's really happening here? We're going from total reported figures. So what are the total reported figures? Let's look at the bottom line of the income statement, which is net income, and the bottom line of the balance sheet, which is equity. And if you really just look at this component right here, right there, the resulting return on equity is including the firm's operations and its investing activities. But the analyst doesn't want to know how your portfolio is doing. They want to know how many widgets you're selling. In other words, they want to know your operations. Are you making money doing your day-to-day business activity? So what the analyst would do is the analyst would remove any investment income from the income statement and remove the value from your balance sheet for any of the investments. And then you would have adjusted figures. So you'd have adjusted net income and you'd have adjusted equity, and the resulting return on equity would just be reflective of the firm's operations without how their portfolio is performing. And I'll tell you why that's important. Because let's just say it's a good year in the stock market. The company's investments are going to be doing really well, but that could mask a deterioration in their operations. But their operations, is really what is sustainable. It's the key to survival in the long term. So it's possible that companies can mask their poor operations, so their business is really suffering. But what's keeping them afloat is their investment income. And really, investment income is not why this company got into business. It's not an investment management firm. It's in the business of making widgets. So what the analyst is more interested in is how's your profitability in making widgets. And a real life example, so when we're analyzing Microsoft, the analyst really wants to know how well its software business is doing, not how well its portfolio is performing.